Hello everyone. The topic of the video is national income accounting. So in this video, the first topic that we will study is about final goods and intermediate goods. Final goods does not undergo further production stage and they are meant for final use, while intermediate goods are used as input or undergo production stage to produce a new good, and they are not meant for the final use. Now, final goods are of two types, that are consumption goods and capital goods. Capital goods are used for production of the other goods, while consumption goods are used by consumer in the same year, and they also include service. Now, final goods in an economy that are produced in a year are used to calculate the value of GDP or final output. Now there is also a concept of flow and stocks. Flow we calculate over a period of time, like how much goods are produced during 4 months, or how much goods produced in a time year, or a time, or we say time period. This is flow, while stocks is we calculate it at a particular point of time, like what is amount of goods at present, or at a fixed particular, or at any fixed particular particular time period. It is stock. Now inventory is the unsold finished goods or goods in process, raw materials that are held by a firm. So inventory is a stock of unsold finished goods of a firm. Now after final goods and intermediate goods, the topic is circular flow of income, and this is for the two sector economy, that is firms and household. In this model of circular flow of income of two sector economy, household provide their factor services to the firm. For these factor services the household provides to firm pay them payments, and from that payment, or say income, household spend on the goods and services produced by the firm. Now there is also a concept कि individual can spend more than what he earns. Spend more. So for that he have to borrow from someone. If he will borrow and spend more or pay to firm, then the demand will increase, then household will provide more factor services. For more factor services their income will also increase. So in this way, if a person will spend more on the goods, then there will be a rise in income in the circular flow of income. But for that they have to borrow from someone else. There will be a leakage. And in this circular flow of two sector economy, we are not considering government or any kind of leakage. Now comes the methods of calculating national income. So there are three types of method: product value added method, expenditure method, or income method. In product method, the value of output, or we say final value of output, is calculated. In expenditure In expenditure method, it is it is calculated by demand side. Demand side, how much households or say government are spending, or or anyone in economy on spending on goods. In income method, national income is calculated by adding the national income calculated by adding incomes of individual in economy. Now the first method is product method. It defines a nation's GDP as the market value of final goods and services newly produced during a fixed time period. Now why the market value we take in this? Because the market value tells us about the value of goods and services at the price at which they are sold in the market, and it helps us to get the market value, because calculating the value of different goods will not be easy. So we will define it in at the market value. Now the problem with market value is that a number of goods are not sold in the formal market. There is also an underground economy that we call also illegal economy. And the value of services by the goods. There are various services like defense and other services for which we cannot get value of those services. So the solution of this problem, the value of services provided by the government, we can solve it by valuing the cost of production of valuing the services at the. Now gross value added of a firm is calculated by subtracting value of intermediate goods from the gross value of output produced by firm. We subtract the value of intermediate goods from the gross value of output, because if we calculate if we also include the value of intermediate goods, then there will be the problem of intermediate of double counting. We will study it in a formula in the next slide. Before that, we study how to get the net value added of a firm. We can get net value added of a firm by subtracting depreciation from the gross value. Now GDP is the sum of the gross value added of all firms in the economy. In the next is expenditure approach. It measures GDP as total spending on final goods and services produced during the specified time. Now there are four major categories of spending that are added in the expenditure approach to get the GDP. These are consumption, investment, government expenditure, and net export. And by adding these four spending, that we will spend on consumption, we do on investment, expenditure by government, and net export, we will get the GDP or total output of the economy. Now here consumption, that is C, includes both spending on domestic goods and also on the goods that are produced abroad, that we imports and consume. And investment also includes spending for new capital goods, that is called fixed investment, and also on the investment done to increase the inventory of a firm. That is called inventory investment. Now fixed investment is also of two type, that is of business fixed. Business fixed is an investment made on its capital, machinery etc. And the residential fixed is for investment done on the housing and residential things. This is also called as investment. Now G is the government purchase of the goods and service, expenditure by government for a currently goods and services. Net export, it is export minus import. So by adding these four things we will get our total output of the economy, or we say GDP. Now next is the income approach, and we get it by adding the incomes received by the producer, that includes profit, taxes paid to government and other. So GDP we can calculate it by wages, profit, interest and rent. By adding all these we can get GDP through income approach. Now key part of the income approach is the concept of national income. National income includes 8 types of income, that is compensation to employees, we can say pay, wage, proprietor's income, that is we can say profit, rental income of a person, corporate profits, net interests, taxes on production and imports, business current transfer payment, and current surplus of government enterprises. Apart from these 8 components, there are 3 other items also that we take into account, that is statistical discrepancy, depreciation, it is wearing of capital goods, statistical discrepancy is errors in statistical calculation, and net factor payments, it is payment received by domestic workers abroad minus payment received by workers of foreign that are working in our country. अब हम तीनों अप्रोच को एक सिंपल एग्जांपल के थ्रू करके देखते हैं. तो फर्स्ट प्रोडक्ट अप्रोच अगर हम करते हैं, फॉर द प्रोडक्ट अप्रोच here firm X and firm Y are the two firms. Wages paid by the firm X is 15,000, taxes 5,000, revenue from the good A that firm X produce is 35,000. It is total. Now good A sold to public is 10,000 and sold to firm Y is 25,000. Firm Y pay 10,000 as wage, 2,000 as tax. It purchased good A from X of worth 25,000, and total revenue of firm B is 40,000. Now from the product approach or value added approach, the final value of output produced by both the firm is 40,000 and 35,000. So we will add up both these and subtract the intermediate value, that is 25,000, and we will be left with 50,000. That is our answer. For the expenditure approach, the expenditure Here will be 40,000, that is on the good B, that is final output of firm Y, and here for the firm X, expenditure on good A will be 10,000. We will not include the purchase of good A by firm Y, because then it will be double counted in this. This good A from the firm X that firm Y purchased is used for the production of good B, and that good B generated the revenue of 40,000. So for that reason we will not include this 25,000 in the revenue of the firm X. Now here total will be 50,000 again. From the income method, here the profit of the firm Y will be 40,000 minus 25,000, and we will also subtract 10,000. 40,000 minus 40,000 minus 25 minus 10, it will be 5,000. Now here the revenue, or say profit, for the firm X will be the 35 minus 15, that is 20. Now we will add 10,000 and 15,000, that are income of the workers. 10,000 plus 15,000, and it will be 50,000 again. Here we did not included the taxes, but if we add up taxes, then also the answer will be same, that is 50,000. Now the question is, why all the three approaches are equivalent? So now the question is, why all the three approaches are equivalent? It is because the market value that are produced, market value of produced goods and services, will be equal to the amount that buyers must spend to purchase or buy these goods. So in this way, value added will be equal to the expenditure. Now what will sellers receive? Sellers will receive what buyers spend. So in this way, expenditure approach will be equal to income approach. So all the three approaches will be same or give same answer. Now we will be back to the private and government sector income. Private income means the amount of income the private sector has available to spend, and the private disposable income will be equal to the sum of GDP net factor payment from abroad plus transfers, interest payment on government debts, and taxes. Now the income that is not at the disposable of the private sector is will be the net income of the government sector. Net government income will be equal to the taxes minus transfers that government will pay to the individuals and interest paid by the government on debt. So this will be equal to the net government income. Now if we add up private disposable income and net government income, net government income, it will be equal to the GNP, that is gross national product, and by adding both the equation we will get YNFP. If we see it in equation form, then we can see it Y plus NFP plus TR plus INT minus transfers and transfers minus taxes minus transfers minus interest payment. So here this will cancel out and Y plus NFP, that is GDP plus net factor payment, will be left. It will be GNP. Now next, so till 2015 GDP was calculated at factor cost and market price by CSO, and from January 25 GDP at factor cost is replaced by gross value added at base price, and GDP at market price is simply GDP at market price is simply GDP. Now factor cost, basic price and market price, these are differentiated on the basis of net production taxes, that are production tax minus production subsidies. Now factor cost, basic price and market price, these are differentiated on net production tax and net product tax. Net production taxes are production taxes, production tax प्रोडक्शन के ऊपर होता है, and if we minus we subtract the production subsidy from the production tax, then we will get the net production taxes, and if we subtract production subsidies from the product subsidy from the product tax, then we will be left with net product taxes. Now production taxes are like land revenues, on the land revenues, stamp and registration fee. Product taxes are like excise tax, service tax, export and import duties. Now so we studied it earlier that GDP and net factor payment from abroad will be equal to GNP, and if we want to get the net value, then we can subtract depreciation from the gross. If we subtract depreciation from the gross value, then we will be left with the net value of a unit. Okay, and if we want to find out the factor cost of production, then we need to deduct the indirect taxes from the market price. Like we can see it here, NNP, that is net national product, at factor cost will be equal to national income. NNP at factor cost is also known as the national income, and we can get NNP at FC, that is factor cost, by subtracting net indirect taxes, that is indirect tax minus subsidies from the NNP at market price. Okay, now the next is saving and wealth. So saving is something that is left out part of the income after our consumption. So private saving will be equal to the private income minus consumption. We studied private income is summation of the GDP plus net factor payment minus taxes plus transfers to the individuals by government or interest paid on government debt. And government saving will be equal to net government income minus government spending. Net government income will be equal to the taxes minus transfers minus interest payment. So we can get national saving by adding up private and government saving. So private saving so by adding private saving and government saving, we will get GDP plus net factor payment minus consumption minus government spending. Now this is the national saving, and saving can be used for the investment purpose to and if government is running in the we can use. Okay, so now the uses of the private saving can be used for the investment, to invest in any business or any kind of new venture, and it can also be used to finance the government budget deficit. Government can borrow from the private saver to finance its deficit, and also to maintain the current account balance. Now, nominal and real GDP. Nominal is something that is calculated at the current price, and real that is calculated at the price of a reference period or a base period. And GDP deflator is a price index, and it measures the overall level of the prices of goods and services that are included in GDP. And we can calculate it by formula nominal GDP by real GDP, and as it is given in percentage form, so we can multiply it by 100. Now this will be the GDP deflator, and it indicates the inflation trends, and inflation is given by the change in the price level, that is price at the current and minus price at the previous period divided by the price of previous period. So this will be the, and now the next index that helps to measure the inflation will be CPI, that is consumer price index. Now it is used for the consumer goods. There is basket for the consumer items for which this index is used, and as GDP is used for the nominal and real GDP, that nominal for the current and real for the base period. Similarly, in this index also we use base and current period price for calculating. So CPI, the formula will be similar, that will be current cost of the basket. Here we will take basket because in this we use a basket of consumer items to calculate the value. So the current cost of the basket divided by current cost of the basket as of the base period multiply by 100. This will give us CPI, consumer price index. Now the last topic of the video is GDP and welfare. So suppose that GDP of a country is increasing, but that is only concentrated to the hand of few peoples, concentrated concentrated to few peoples, so then it will not give the real picture of about welfare or about increment in the lifestyle of the every individual of the country. First one is the distribution of GDP. Now if the GDP of the country is rising, the welfare may not increase, because GDP may be concentrated in the hands of few people. Then if it is concentrated to only few people, then how can that be welfare to the nation? Now if GDP is falling, then definitely it will not be the welfare of the nation or individuals. Now also there are many non-monetary exchanges like domestic services that women provide their services, but they do not get paid in exchange. So these services are also not added to the GDP. That is also that also provide an underestimation of the GDP. There are also underground economy, many activities that are illegal but are produced in a economy, so they are also not included. So that also gives an underestimation of the GDP value, and it is also a problem. Now the externality is also there. Now what is externality? Externality is the benefit, or we also a harm, a firm or an individual cause to another. Now suppose there is a fish farm and a chemical factory, a chemical factory and a fish rearing downstream to the downstream of factory. So chemical factory अगर अपने chemicals release करेगी उस downstream में, तो fish rearing will be problematic. Then that will be negative externality. It cause harm to the fish rearing. And if suppose, like we can take example from the COVID, if one person is vaccinated for the COVID, then the other person will also be benefited, that there will be chances that he will not get the disease from the vaccinated person. So that will be the positive kind of externality. So if there is negative externality, then there will be underestimation of the GDP. And if there is positive, okay, sorry, if there is negative, then there will be overestimation, and if positive, then there will be negative estimation of the GDP value. Now negative externality, how negative externality gives the overestimation about the GDP as a measure of welfare. Suppose there is a chemical factory release, and it releases its chemical to water body. Now the people or people in surrounding will drink, and they will get caught by disease. So that will be, there will be fall in welfare. But what we are getting, that company chemical factory is adding some value. We are not calculating its harm that it is adding to the environment by releasing its chemical to the water body. So in this way, negative externalities give the overestimation, and positive externality gives the underestimate idea. Okay guys, that's it for the video, I think. Thank you for watching the video. Hello everyone. The topic of the video is national income accounting.